Hello traders, let's discuss one more strategy for bearish market. Well, this strategy is super important. Why? Because there is a certain area, if your stock or index ends in between that area, then only you are going to occur some losses, otherwise you will be in profit. So here I'll be explaining you put back spread. So if your stock goes down, then you are going to get unlimited profit, and if it goes up, then above certain points it is going to give you only zero losses. In this strategy you will see that it is similar to ratio spread. So how you can gain unlimited profit with limited risk involved. First of all, let's see what is this strategy. This strategy name is put back spread. Well, here what we do, well, if you see here, then we sell options and buy options on put side. So how many number of options we'll be selling, how many numbers of options we'll be buying, well, this all details I'm going to give in this video. So stay tuned and watch this complete video. Here what we will be doing, we will be buying options out of the money to lot, and we'll be selling options in the money. Buying will compensate selling. I'll be taking here the example of Bank Nifty. Now let's see few more points about the strategy. So underlying assets will fall significantly in near terms, then you can apply this strategy and gain unlimited profit. Put back spread is reverse of put ratio spreads, but it is similar to ratio spreads. That's what I'm telling you, that you'll be finding some of the similarity with put ratio spread as well. Well, here you'll be gaining unlimited profit with limited risk involved. Now let's see this on our table. So if you see here, the strategy name is put back spread. Here, if you are expecting significant downside movement, then definitely we can apply this strategy. And what will be upper break-even point? Well, it will be simple. Strike price of short put, means the strike price where we have shortened the put, plus premium received minus premium paid. Sometimes premium received minus premium paid will be zero in most of the cases if you apply this strategy. But if there is some value, then definitely you have to put it here, means premium received minus premium paid, so that you can get upper break-even point. What will be the upper break-even point? That also I'm going to discuss in our payoff graph. Well, what will be our lower break-even point? Lower break-even point will be long put strike minus difference between long and short strike premium received or paid. Well, what is the risk? Risk is limited. And if you see the rewards is unlimited if stock goes down, because here we are doing put back spread. There is any margin required? Definitely there is some margin required because we are selling options. Now let's see how we can implement this strategy in Bank Nifty. So if my view about the Bank Nifty becomes bearish, then I can implement this strategy. Currently Bank Nifty is trading at 30,402. So if you see the at the money is at 30,400. So here I am selling at the money of one lot. And how much premium I am gonna receive? I am gonna receive 330.95. I am also gonna buy put, that is out of the money, and that is of two lots. So this premium which I'll be paying, if you double this, then you will be getting 330.95. So we have to select the strike price in such a way that premium paid should be almost twice of your premium received, so that you can gain profit if stock goes down. Bank Nifty, well, here I have shown you one example. So now if you want to find out upper break-even point, then this is the upper break-even point. How you will calculate upper break-even point? It is very simple. 30,400, then you have to subtract whatever premium you are receiving here. Okay, means whatever value you are receiving, you have to subtract from 30,400 and you will be getting your upper break-even point. Well, how you can calculate lower break-even point? This is also very simple. In order to calculate lower break-even point, you have to see the payoff graphs. So payoff graph calculations, you can do it through our tables. That also I'm going to show you in few minutes. So there you have to find out where maximum loss is occurring. So how much points loss is occurring? Maximum loss you have to subtract from this value, which is put strike price of 30,000. Here in this case, maximum loss was 400 points. So I have to subtract 400 points from 30,000. Then I'll be getting my lower break-even points. Again, I'm telling you how you will get this upper break-even point. Upper break-even point is simple. You have to take this strike price at the money, then you have to add or subtract the value which you are getting here. Then you will be getting upper break-even point. How will you get lower break-even point? First you have to take this value where you have buy the put. Then you have to subtract maximum loss points. So here in this case 400. So if you subtract 400 from 30,000, then you will be getting 29,600. Let's understand this in more better way in our payoff graphs. So first let's see what payoff graph is saying. If you see the payoff graph, then here, if Bank Nifty goes below 29,600, then we are going to get profit. At 29,600, we'll be getting no profit, no loss, means zero profit. And further, if it goes down, we are going to get profit. Well, if you see, what if it increases instead of decrement? Up to 30,300, we'll be getting some losses. Once it goes beyond this 30,400, then we'll be getting zero profit, zero loss. So if Bank Nifty ends in between this range, 29,700 to 30,300, then only you are going to get some losses. Otherwise, you will be in profit only. That is the USP of this strategy actually, because it is giving the loss within certain range only. Once it breaks that range, either you are going to get some profit or zero loss. Let me show you how did I calculated this payoff. So if you see, we have sold one put and we have sold at the money put. Currently, it is at 30,400. So we have sold 30,400 put and we received a premium of 330.95. So if Bank Nifty ends below this or at this point also, then we are going to receive 330.95 premium in our account. So you have to multiply it with 25 so that you can get profit and loss in terms of rupees. So if it goes below this, then you will be occurring some losses. How will you calculate the losses? Well, if it goes 100 points down, then you have to reduce 100 points from this premium. Means 230.95 will be your profit. If it goes further 100 points, then you have to reduce again 100 points from this LTP. If it goes further down, then you can take another 100 points. Well, why I am taking 100 points? Because the difference between this strike prices is 100. Whatever difference is there, that much loss you are going to occur if it goes below this. Suppose if it was 50, then you have to reduce the 50 from 330.95. But here it is 100 points gap is there in strike price. So you have to reduce 100 points. Well, what if it goes up? Well, if it goes up, then you are going to receive this premium into your account. So that will be 330.95. Now let's calculate it for net payoff from put buy. So you have bought the put at 30,000 and that is of 2 quantity. So here this 33.95 is of 2 quantity. So you have to multiply with 2. 30,000 if you will see 165. So 165 multiplied by 2 is equal to 330.95. Because we have bought 2 lots, so we have to multiply the last traded price of that strike price means premium into 2. Then you will be getting 330.95. So if it goes down, then how much profit or loss you will be having? Well, if it goes down, then put will start giving you profit. How much profit it will be giving you? Well, it will be giving you 200 points profit if it will jump from 30,000 to 29,900. Here it is 100 point gap is there. Ideally, I have to subtract 100 points only. But since we have bought 2 lot, so we are going to deduct 200 instead of 100. 100 is for 1 lot. If you are selling 2 lot or if you are buying 2 lot, then you have to subtract or add twice of that strike price difference. That's how you will be able to calculate the payoff graph from buy or sell. Okay. So here we'll be adding 200, then minus 330.95 plus 200, then minus 130.95. So your losses is decreasing. If it goes further down, then you are going to have more profit from this. Well, what if it goes up? If it goes up 30,000 or if it remains also at 30,000, then you are going to have 330.95 loss in your account. So that's how we can calculate the payoff from put buy and put sell. And what is net payoff? Well, net payoff you can get if you add both of this, then you will be getting net payoff. And here that will be your lower break-even point. That's what I was telling you, that where will be lower break-even point and where will be higher break-even point. And the higher break-even point will be at 30,400. Let's draw it on chart so that we can get better idea about it. So here on the x-axis I have taken strike prices, on y-axis I have taken net payoff, and here I'll be drawing my chart. So if you see here, upper break-even point will be at 30,400 and lower break-even point will be at 29,600. If Bank Nifty ends within this range, then only you are going to occur some losses. Otherwise, you are going to have profit or no loss, no profit. So maximum loss, how much you can occur? Well, it will be of 400 points. That's what I was telling you. When we calculated lower break-even point, this value we needed it because we have subtracted it from 30,000. Means wherever you have bought the positions on put side, from that 30,000 you have to subtract this maximum loss of points, then you will be getting your lower break-even point. So that much loss maximum can occur point wise. You have to multiply it with 25, then you will be getting loss in amount. So here if you see, then maximum loss is 10,000 and maximum profit is unlimited if it goes down instead of up. That's it guys for today's video. If you found this video helpful, then hit the like button and consider subscribing this channel.